Okay, so let's unpack this. Imagine you're right here in Indonesia. You've got $12,000 USD ready to go.
Mm-hmm.
And the mission, it's pretty clear. Get some passive income flowing from it.
Yeah, all looking at three specific Indonesian government options.
Yeah.
We've got the SR022T5, that's a Sukuk Retel in Rupiah, and then two in US dollars. INDOIS54NEW and INDOIN35.
Right. And this deep dive, it's totally based on your stuff, trying to figure out what kind of income can you actually expect.
Exactly.
But hang on, before we even get into the coupons and the yields, your sources flag something really, really crucial, maybe the biggest hurdle.
Absolutely. The minimum investment, especially for those USD bonds, if you're buying them on the secondary market,
Okay.
it's not straightforward. For the SR022T5, the Rupiah one, no problem. Minimum is tiny, just 1 million Rupiah. Your 12K converts to what, around 195 million Rupiah? Plenty.
Easy access there. But the USD bonds, INDOIS54NEW and INDON35, this is where the $12,000 hits.
Precisely. It varies massively depending on the bank or
How
platform.
much variation are we talking?
Well, some banks your sources mentioned, like BCA or OCBC, might have minimums as low as $1,000 or maybe $10,000 for secondary market trades. If that's your bank, 12K could possibly work.
Okay, possibly.
But many others listed, UOB, CTBC, BRI, Pan and Bank, HSBC, your sources say they often require $20,000, $50K, even $100,000 or $200,000 minimums for these same bonds.
Wow. Okay, so you're...
Nope, not even close for those higher thresholds.
So step one, absolutely based on this material. You have to check with your specific bank or investment platform here in Indonesia. Can I buy INDOIS54NEW or INDOIN35 on the secondary market with $12,000 USD?
Yeah, because if the answer is no, if their minimum is 20K or more, then honestly, talking about these USD bonds in detail might be just academic for you right now. Right, it's the critical feasibility check. Let's look at what each one offers.
SR022T5, the Rupiah Sukuk. Key features.
Okay, so it's an Indonesian Rupiah IDR, fixed on 6.55% per year. This is nice for passive income seekers. It pays out monthly.
Monthly, okay.
Matures in 2030, so that's a 5-year tenor from its issue. Government guaranteed, very low default risk, and we already said low minimum, easy to get into.
If you put in the equivalent of 12K.
Right, so around 195 million Rupiah after the 10% tax, 959,543 per month.
Which in USD terms is about $59 at current rates.
But here's the main risk for you, currency risk. Your USD is now IDR. That monthly payment, its value in USD, and the value of your principal when you get it back in 2030.
Depends entirely on the USD IDR exchange rate.
If the Rupiah weakens against the dollar, the USD value of your investment goes down.
Okay, now the USD bonds. Assuming access first. Big advantage. It's in US dollars.
A natural hedge against that Rupiah depreciation we just talked about. Fixed coupon is 5.65%, but it pays semi-annually, not monthly.
Semi-annually. And the maturity on this one?
It is. Your sources point this out clearly. November 2054, that's almost a 30-year commitment.
And there was something about the price. It's not trading at face value.
Your material shows it's trading at a discount, around 96.75 cents on the dollar.
Ah, okay. So you pay less than 100, but you get 100 back at maturity in 2054.
Precisely. And that difference impacts your overall return. Even though the coupon is 5.65%,
your actual return is higher if you hold to maturity.
It's really the key figure when you buy bonds on the secondary market away from face value. Your sources put the YTM at around 5.85%. That's your effective annual return.
5.85% YTM. And the income stream from the two bonds?
After tax, it's about $52.56 USD per month, averaged out.
Right. And the risks here, besides the access issue?
Well, two big ones jump out from the sources. One is liquidity risk. Trying to sell $12,000 worth before 2054 might be tough on some platforms.
So because of the long tenor.
Prices of long-term bonds like this are very sensitive to interest rate changes. If rates go up, the market value of your bond can drop quite a bit.
Okay. Now the last one. INDON35, also USD, also government guaranteed. This one's coupon looked really high in the notes.
It does. That's the headline feature. 8.50% per year nominal coupon. Huge. Paid semi-annually. Matures in 2035.
There's always a but, isn't there?
Absolutely. And this really drives home why you can't just look at the coupon. INDON35 is trading at a big premium. Your notes say around 125.275% of face value.
So you pay 125.275 cents to get $100 back in 2035.
That's right. You're paying over 25% more than its maturity value.
So even though you get those like fat 8.5% coupon payments along the way,
that big upfront premium eats into your overall return significantly if you hold it until maturity.
And the YTM for INDON35 is...
Despite that huge coupon, the YTM is actually lower than the other USD bond.
Interesting. So INDOIS54NEW at 5.85% YTM is a better overall return than INDOIN35 at 5.38% YTM, even though INDOIN35 pays a bigger coupon.
If holding to maturity is your plan or the most likely scenario due to potential liquidity issues with a smaller amount, yes. The YTM captures the total return picture, including that capital loss you take on INDOIN35 because you paid such a high premium.
What about the monthly income feel? INDOIN35 must provide more cash flow.
It does. The coupon payments after tax average out to about $61.07 USD per month, or nearly 1,000,000 rupiah. So higher cash flow but lower total return measured by YTM.
And the risks for INDOIN35, similar story.
The big access hurdle for $12K. Then market risk, less sensitive than the 30-year bond, but still definitely there. And that guaranteed capital loss, if held to maturity, paying 125, getting back 100.
Okay. Wow. So let's try and bring this all together for someone sitting with $12,000 wanting that passive income in Indonesia.
SR022T5, the Rupiah option. It's accessible, guaranteed monthly income in IDR. Simple. The big trade-off. Your initial USD capital is now exposed to USD IDR currency fluctuations.
Then the USD bonds, INDOIS54NEW bill, and INDOIN35. They offer that currency hedge, paying you in USD, but that massive, if you can actually buy them with $12K through your bank, it's a big if.
A very big if. And if you can get access, then you really need to compare the yield to maturity. The INDOIS54NEW, bought at a discount, offers a slightly better overall return potential, 5.85% YTM, than the INDOIN35 bought at a premium, 5.38% YTM.
And that YTM might be the most realistic measure, because selling a small $12K chunk before maturity could be difficult anyway.
Could be. Liquidity for smaller, odd lot amounts can be challenging in bond markets sometimes.
So to summarize from your sources, SR022T5 is the clear, easy path for monthly IDR today, accepting FX risk. USD bonds could give USD income and FX protection, but only if you clear the minimum hurdle.
That captures the core trade-offs presented in the materials.
Okay, so here's a final thought, something for you to chew on. Given that the rupiah has generally tended to weaken against the US dollar over the long term, how much weight do you give that potential currency protection from the USD bonds? Does that outweigh the simplicity and guaranteed monthly IDR from SR022T5, especially given the potential difficulty of even buying those USD bonds with just $12,000?
And maybe thinking even further, what does that historical currency trend mean for your actual spending power here in Indonesia over the next 5, 10, or even 30 years?
Right.